Imagine opening your mortgage renewal letter and seeing your monthly payment jump by hundreds of dollars. Not because you bought a bigger house, not because you missed payments, not because your bank suddenly discovered a new hobby called ruining your Tuesday, but because the interest rate you had before was much lower than the interest rate being offered now. For many Canadian homeowners, this is the 2026 mortgage renewal shock. And the scary part is this: your mortgage payment might not go up by a little. Depending on your balance, your old rate, your new rate, and your amortization, it could go up by enough to change your entire monthly budget. So in this video, let's break it down with simple math. No confusing bank language. No mortgage jargon soup. Just the numbers you need to understand before you sign anything. Quick disclaimer before we start. This video is for general educational information only. It is not personal mortgage, financial, legal, or tax advice. Your situation may be different, so always confirm your numbers with your lender, mortgage broker, financial institution, or a qualified professional.
Now, let's get into it. Here is why 2026 matters. A lot of Canadians who got mortgages or renewed mortgages during the low-rate years are now reaching the end of their mortgage term. In Canada, many people do not lock in one mortgage rate for the full 25 years. Instead, they often have a 25-year amortization, but a shorter mortgage term, like 5 years. That means every few years, they have to renew. And when they renew, the lender uses the new interest rate environment to calculate the next payment. The Bank of Canada has said that many mortgages renewing in 2025 and 2026 are expected to see payment increases, especially people who had 5-year fixed mortgages from the low-rate period. So this is not just one homeowner having a bad week. This is a major Canadian household budget issue. And in a minute, I'll show you how a mortgage payment can jump by more than $700 a month using simple numbers. Let's define the problem. Mortgage renewal shock is what happens when your current mortgage term ends and your new mortgage offer comes with a much higher payment than you expected. It usually happens because of 5 things: your old interest rate, your new interest rate, your mortgage balance, your remaining amortization, and your other debts.
Think of it like a pressure cooker. The interest rate is the heat. The mortgage balance is the size of the pot, and your monthly budget is standing nearby, nervously holding a calculator. If the heat goes up and the pot is huge, something has to give. That something is usually your monthly payment. Let's use a simple example. Suppose a Canadian homeowner has a mortgage balance of $500,000. Their old interest rate was around 2%. Their new renewal rate is around 4.75%, and they have about 25 years of amortization left. At 2%, the monthly payment would be roughly $2,120. At 4.75%, the monthly payment would be roughly $2,850. That is an increase of about $730 per month, or about $8,760 per year. And remember, this is only an example. Your real number depends on your actual mortgage balance, rate, amortization, and lender terms. But this shows why renewal shock feels so painful. Because $730 a month is not just a mortgage change. That is groceries. That is car insurance. That is daycare. That is RRSP contributions. That is retirement savings. That is the "I was going to fix the furnace, but now I'm pretending that noise is normal" fund. Now, you might hear average numbers in the news and think, okay, maybe it won't be that bad. But averages can hide the real pain. The Bank of Canada estimated that the average monthly payment could be higher for many people renewing in 2025 and 2026. But the impact depends heavily on the mortgage type, balance, and original rate. Some Canadians may see a small increase. Some may see almost no shock because they already adjusted. But others may see a much larger increase,
especially if they had a very low fixed rate and a large mortgage balance. So the question is not, what is the average Canadian facing? The better question is, what happens to my payment when my mortgage is recalculated?
This is where many people make the biggest mistake. They focus on the rate, but the payment is what actually hits the bank account. The biggest shock may hit people who had very low fixed rates from the early 2020s. For example, someone who locked in a 5-year fixed mortgage when rates were low may now be renewing into a much higher rate environment. CMHC has said that although renewal volumes may ease in 2026, borrowers renewing after a 5-year term may still face a similar interest rate shock to borrowers who renewed in 2025. The shock may also be harder for people with large mortgage balances. A rate change on a $200,000 mortgage is one thing. A rate change on a $700,000 mortgage is very different. It may also hit harder if the household already has car payments, credit card debt, lines of credit, childcare costs, or rising property taxes. Because the mortgage does not renew in a vacuum. It renews inside your real life. And real life includes groceries, hydro, insurance, kids' activities, winter tires, and that one subscription you keep forgetting to cancel. Fixed rate and variable rate borrowers can feel renewal shock differently. A fixed rate borrower may feel the shock suddenly at renewal.
For years, the payments stayed the same. Then, the renewal letter arrives, and suddenly, the new number is much higher. Variable rate borrowers may have felt the pain earlier, especially if their payments adjusted as rates moved. But there is another situation that can surprise people. Some variable rate mortgages have fixed payments. When interest rates rise, more of the payment can go toward interest instead of principal. That means the renewal problem may not just be the new rate. It could also be that the mortgage balance did not fall as much as expected. That is like running on a treadmill and realizing the treadmill has been moving backward. Not fun. Before signing a renewal offer, there are a few things Canadians should check. First, check your current mortgage balance. Second, check your remaining amortization. Third, check the renewal rate being offered. Fourth, compare what the new monthly payment would be. Fifth, check whether there are fees if you switch lenders. Sixth, check whether the offer is fixed, variable, or another structure. And seventh, check your full household budget after the new payment.
The Financial Consumer Agency of Canada says Canadians can negotiate with their current lender and may qualify for a lower rate than the one quoted in the renewal letter. It also says borrowers can compare offers from other institutions or mortgage brokers, but should understand possible switching costs. So, the key lesson is simple. Do not only ask, what is the rate? Ask, what is the full monthly payment, and can my household survive this number? Here are common renewal mistakes. Mistake number 1, accepting the first offer without comparing. Your renewal letter may be convenient, but convenient does not always mean cheapest. Mistake number 2, waiting until the last minute. Lenders must provide renewal information before the end of the term, but waiting until the final days gives you less room to compare and ask questions. Mistake number 3, only looking at the interest rate. The rate matters, but the payment, amortization, flexibility, penalties, and total cost matter too. Mistake number 4, extending amortization without understanding the long-term cost. A longer amortization may lower the monthly payment, but taking longer to pay off a mortgage usually means paying more interest over time.
Mistake number 5, ignoring the rest of your debt. A mortgage renewal can be stressful on its own, but if it renews at the same time as credit card debt, car payments, and lines of credit, the pressure can build fast. Here is the simple formula to remember. Mortgage renewal shock equals old rate, new rate, balance, amortization, and other debt.
old rate, new rate, balance, amortization, other debt. That is the 5-part checklist. If your old rate was low, your new rate is higher, your balance is large, your amortization is tight, and your other debts are already heavy, the renewal can feel brutal. But if you check the numbers early, compare options, and understand the trade-offs, you are not walking into the renewal blind. And that is the whole point. Not panic, preparation. Before your mortgage renews, write down these numbers: your current balance, your current rate, your renewal date, your lender's renewal offer, your estimated new payment, your remaining amortization, your other monthly debts. Then ask one simple question. Can my budget handle this payment without relying on credit cards? Because the real danger is not just a higher mortgage payment. The real danger is a higher mortgage payment that quietly pushes the rest of your life onto debt. And once that happens, the mortgage renewal shock becomes a full household budget shock. If this video helped you understand mortgage renewals in plain English, please subscribe to the channel. It helps me keep making simple, practical Canadian personal finance videos like this. And comment below. Are you renewing a mortgage in 2026? Or are you trying to prepare early? I may turn your question into a future video. Remember, this video is general education only. Confirm your own numbers with your lender, mortgage broker, financial institution, or a qualified professional before making decisions. Thanks for watching, and I'll see you in the next video.